You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey. I'm doing a unique situation here. I've got a unique guest, and we're doing sort of a bonus podcast because I think it's that time of the year when people are trying to figure out what they can potentially do to legally reduce their taxes. And if you're in the accredited investor group, you've heard us talking about various options such as oil and gas, again, 100% depreciation there. You heard our informational webinar on conservation easements, whether you want to participate in something like that or not. By the way, I should point out, you should join Investor Club if you haven't to get this kind of information. We're only focusing on stuff that is specific to accredited investors. So that is that. Now, one of the ways that I think is the purest and probably the best way to get depreciation that's been around for a long time is through depreciation in real estate. Obviously, this has been around forever. It's why real estate investors generally have the luxury of having significantly less tax burden than their peers. I wanted to bring on a guest today named David Brizel, who is a CPA, part of Brizel and Associates, and he is an expert amongst in other areas. He's an expert in the area of cost segregation analysis, and this is something that is applicable not only to those who own property that by themselves. But you see, we've done cost segregation analysis and bonus depreciation on several of our apartment buildings within the investor group. But what I wanted to talk to David about today was, just breaking down what exactly cost segregation is and, some concepts around bonus depreciation. A little bit of context here. I own a couple of houses in Illinois. I didn't buy them recently, so it was not after this bonus depreciation rule. And it hadn't really even occurred to me to do cost segregation analysis on them because they're houses, right? I usually think of doing cost segregation analysis on apartment buildings. And I don't know why I didn't even think about it. It just seemed like it was probably going to be too expensive to make sense. But anyway, somebody told me, this guy, David Brizel, in our Wealth Formula Network group, he does these things on homes. He's very reasonably cost. And then the next thing you know, like 5 other people in the group said, yeah, I know David. David's awesome. I love David. And it was like, people were sending me random emails telling me how much they love David and what great work he does. So I said, I got to get this guy on, especially at the end of the year right now. So David, I've been long-winded, but thanks for joining us today.
Thank you.
So David, what exactly is a cost segregation analysis? And I know you're a CPA. Give us sort of a high-level idea on what it is.
What it is that for those who invest in real estate, namely, especially if it's residential real estate, they get to depreciate the value attributed to the building structures over 27 and a half years. As for commercial real estate, it would be over 39 years. What we do is we come along and we identify specific assets that are in the building and on the building that actually qualify for accelerated depreciation, as well as assets that are outside of the building, which are called land improvements, such as landscaping, concrete driveways, concrete sidewalks, pavement, etc. Those assets are considered 15-year property. Now, with the new tax law that was passed a couple of years ago, what it has allowed is that anything that we segregate, which will definitely have a depreciable life of 20 years and under, can then be written off 100% in the first year. You don't have to do that, but you are now allowed to do that.
And that's what we call bonus. That's through bonus depreciation. That's what we talk about all the time, correct?
That's right. And the thing about the bonus depreciation, now bonus depreciation has been around since 2001. but there were 2 years, 2005 and 6, where it was not applicable. Then it came back. But under the old rules, which is pre 2 years ago, bonus depreciation only applied to newly manufactured assets with a depreciable life of 20 years and under. Therefore, if you bought an existing property back then, you were not eligible for the bonus depreciation. You were only eligible for the accelerated depreciation. Now you're eligible for the bonus depreciation, whether the asset is new or used. Also, the previous bonus only allowed you to take 50% and then depreciate the other 50% over its depreciable life. Now you're allowed to take 100%.
So that is huge. And I should point out too, like this bonus depreciation is huge for real estate investors, particularly for people like me who are in the real estate professional category. Do you want to talk a little bit about some of the limitations for, the people who have the real estate professional designation versus people who do not?
Yeah. What the real estate professional designation is it's an election that you make where what you're claiming is that you're spending at least, I believe it's 750 hours per year managing real estate. And it's also, I believe it's at least 50% of your total hours. I'm not 100% sure on the allocation, but
there's some other nuances to it too. Basically,
Yeah.
you can't have another job and do this, but you have to be, 750 hours plus, and then there's a few other like sort of more specific things. But bottom line is it does create a difference. So go ahead and talk about what's normal and then what that opens up.
Yeah, and so if you do not make that election, or if you're not eligible to make that election, then you could be subject to the passive loss rules. And what that means is that any investment you make in a passive activity, and real estate rental is always considered a passive activity, you are only allowed to take losses to the extent of passive income. Any losses that exceed that would then have to be suspended and carried forward indefinitely until you can use those losses. If you have made the real estate qualified real estate professional election, then you are eligible to write off all real estate losses against other income, whether it's passive or non-passive.
So as you can imagine, that is a really big deal. And of course, not everybody is able to, a lot of people, most people work, a job for a living.
Right.
And in that case, you're not going to be able to do that.
Actually, let me correct myself. You would not be able to write off the real estate losses against passive income if you are a qualified real estate professional. So I just needed to throw that in there. Go ahead.
Right. But here's an interesting concept. Okay, so say you're not a real estate professional, but you have passive income that it's not benefiting from any sort of tax mitigation. So in our group, for example, we have a number of physicians who have surgery centers, we have infusion centers, things that are considered passive income, but have no tax benefits. So you can use these bonus depreciation numbers in that scenario where if you have $100,000 in passive income and all of a sudden you got a K1 with a $100,000 loss because of real estate, you could then apply that to your passive non-tax sheltered income, correct?
That's correct.
So a number of people are doing that in our group, which is huge. And, and I know some of this is, you guys hear me talk about this all the time, but this is how this works in action. Now, what I was getting at a little bit earlier with David, I want to jump into a little bit more because, it's the end of the year. And again, if you're not starting to think of different things that you can do at this point, and if you want to do things, you better do it quickly because you're going to run out of time. By the time this place is going to be in the second week of November. And so for me, what happened is I have these single family homes in the Chicago suburbs, and I didn't, and I'm renting them both. And one of them happens to be a house that I used to live in, and I bought the house back in, I think, I want to say maybe it was 2012 or something like that. David probably knows better than me because he did the study. But then I started renting it once I moved out to California, and that was in 2017. So, David, do you want to let's focus in on that particular situation and sort of the general issues involved in my case, too, because I think they're interesting because a lot of people have homes that they may have lived in at some point and now they're renting them out and they're not even thinking, hey, this could be something I could do a cost segregation analysis on. Talk about the specific issues that, that relate to a house that you're living in and suddenly you're renting it.
Well, it's the same thing as if you bought a house and started renting it. What happens is the date that you begin to make it available for rent would be considered the date it's placed into service. So depreciation would begin on that date, as opposed to when you bought the property or when you invested in renovating or improving it.
Right. So basically, that's what I'm getting at is. Basically, you haven't lost an opportunity because you lived in it. But if you bought it before the new tax law, you cannot use bonus depreciation, correct?
That's right. If you bought it as a used property, that's correct. But
Right.
the renovations, you would still be able to, you'd be able to take the bonus on. It would just be the 50% bonus. And that would be the renovations that qualify for accelerated depreciation. Some of the renovations won't, and then they'll get depreciated over 27 and a half years.
And when was the cutoff for bonus again? Was it 2017 or 18?
It was 18. For the new,
Yeah.
It would be an asset that was contracted to purchase as well as placed in service on or after September 28th, 2017.
Okay.
Yeah.
Okay. Yeah. Yeah. I mean, that's a very useful thing. Now, for those of you who are thinking, well, gosh, well, that's too bad. I missed out on the ability to use bonus depreciation because I moved out of this house and I've been renting it for a while. There's something else called catch-up depreciation. So can you explain what that is?
Yes. Okay. If you started renting your property out, let's say in 2014, and you have been depreciating it over 27 and a half years, as is the case for residential rental property, then we come along and do a cost segregation study for the 2019 tax year. All of the 5-year property that we segregate would be retroactive back to 2014. So then you'd have 2014, 15, 16, 17, 18 as catch-up. The depreciation that you missed in those years, you would then be eligible to take in 2019. And then for the 5-year property, you would get that last half a year in 2019. But for the 15-year property, you'd still have another 10 years or so to continue depreciating it on a faster basis than if it was still at 27 and a half years.
The numbers can get pretty significant then, because if you're talking about a house that you've been renting for 5 years, a lot of a decent chunk of that, is going to be as good as bonus depreciation at that point, right?
That's right.
It's
almost as good. Yeah.
Yeah, almost as good. So it's a really good opportunity for people who are not doing this. Now let's talk, again, one of the things that kept me from doing this initially, David, was thinking, well, I do this with apartment buildings all the time, but I didn't really think that it would be cost effective to do this in a single family home rental. And obviously that's not true because you've been doing this, at multiple ranges of not only single family homes, but also, anything, self-storage, apartment buildings, et cetera. At what point talk about when it might be appropriate to do a cost segregation analysis. I mean, at what level of price of a property?
We have found that anything that might have a purchase price of around, let's say, $45,000 and up can benefit. Now, obviously, let's say you buy a single-family dwelling in a city like Detroit, for example, where you can find a lot of homes that might be 3-bed, 2-bath homes, a typical size lot for $45,000. The benefit's not going to be tremendous, but it will still be better. It will still outweigh the cost.
So I think you do a free analysis though for people who are interested. Yes. Is that correct?
Yeah, up front, we'll give you an estimated projection of what we think the likely benefit will be to you, along with the quote to do the job, and then you can make the decision if you want to go forward with it. And that process is free.
Yeah. So in my case, I just David just finished one of the projections on one of my houses, and it was it's going to be a good chunk of savings. So basically, what he came up with that it is approximately, in my case, because I started renting my place in October of 2017, and David, the numbers you got, basically what we're going to be able to, the projection here is 8% of the purchase value of the property when I first bought the house back in 2000 and I believe I bought it in 2012. Anyway, that ends up being a decent chunk for this. Is a house I used to live in. It's a big house. It's not like a little house.
Wait a minute, are you looking at that 8% number that's off to the right in that worksheet I gave you?
No, I was just doing the calculation in my head.
Oh, okay. Got it. All right.
That
was a discount factor, and I didn't know if that's the.
Oh, okay, got it. Well, listen, hey, it was a great big house and stuff like that too. Yeah. So I do want to make sure that if people are interested in this kind of benefit, David is based in Phoenix but travels all over the country. Everybody who is, I went into Wealth Formula Network. I asked everybody who they thought was the guy, and David was clearly the guy. He's very much beloved in this community, I guess, and I had no idea. But if you're interested in connecting with David, if you have a situation like this, David, the website is what?
The website is costsegstudy.com, COSTSEG study.com.
And in your email is David at cost.
It's costseg at costsegstudy.com.
Oh, okay. Costseg at costsegstudy.com. You can also just email me at buck@wealthformula.com, and I will forward your email to David. One more thing, and I'll say it selfishly, if people are thinking about doing this this year, I would highly encourage you to do so, particularly if you have homes in the Midwest, because even though David travels, people have them from all over the place. Oftentimes he does cost shares for those travel costs. So if you need something done in the Midwest, let him know as soon as possible, because he's going to be out there for my houses and we can split the cost.
Right.
David, anything I missed out here that we ought to know about?
One thing to know about when it comes to renting out a property that you already lived in is that be mindful of the fact that in order to avoid capital gain on the sale of that property in the future, you must have lived in it for at least 2 of the last 5 years that you owned it.
Great.
So that's just something to keep in mind. And so sometimes what you can do is, let's say you move out of it, rent it out for 2.5 years, and then sell it, and then you will avoid any capital gain.
Right. Interesting. Well, that's an extra benefit to notice about that. How does, in that situation too, if you how does recapture work in that kind of situation? Is that counts as a capital gain, so you may not need to pay it, right?
Well, yeah, if you sell the property at a gain, you're still going to have depreciation recapture. There is a possible way around it. It just depends on facts and circumstances. And when it comes to a single family dwelling, if you sell your single family dwelling in the buy-sell agreement, if you list the assets that we segregate and then negotiate a value of those assets to be as low as the buyer will accept, that could mitigate or eliminate depreciation recapture, or perhaps even create a Section 1231 loss, which would be very favorable. The reason this could work with a single family dwelling is because most likely an investor selling a single family dwelling is going to end up selling it to a prospective homeowner as opposed to another investor. And since you cannot depreciate your own home, the homeowner may not care as to what value those things are. Now, the potential drawback is that if they're going to get a mortgage, it's possible that the bank may frown on these assets being valued lower, and it may preclude them from getting a loan amount that they're trying to get. That remains to be seen, but that's also possible.
Interesting stuff, David. Anyway, it's been good to have you on. And again, reach out to David. And, I'm also going to send out an email with your information on there as well. And David, thanks for your time today.
Sure. May I add one other thing?
You bet.
For those properties in, say, the East Coast or the upper Midwest, if you're doing it for 2019, the study only needs to be done by the time you file your 2019 tax return. It doesn't have to be done right now. I mean, obviously, there could be the potential to group travel, but the thing is that if you don't have architectural drawings for the property, and typically single-family dwellings don't have them, then what you're going to want, what will need to happen is there needs to be no accumulation of snow on the ground, because I need to be able to assess what's there. So if it's not done anytime soon, then you might want to wait until April or May to do it, and then just make sure that extensions are filed for 2019.
Got it. Okay, everyone. Thanks again, David. And it was great having you on Wealth Formula Podcast.
Thank you.
All right. Take care.
All right. You too.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.